Hello, and thanks so much for checking out the Coin Stories podcast video page. I'm Natalie Brunell, and normally I talk to the leading voices in Bitcoin, but today I have a very special episode with one of my favorite guests talking about the big economic picture at large and whether we're headed for a major crash. He's one of my most popular guests from the past. But first, I do want to share this podcast does not provide financial advice. It is for educational and entertainment purposes only. I'm super excited to share this episode is brought to you by the Bitcoin Conference 2022. I'm so excited. I'm going to be a speaker this year in just 2 months. That event's going to be held in Miami, April 6th through 9th, and it's going to be the biggest Bitcoin event in the world. All 4 days will be jam-packed with exclusive content, exciting announcements, and an incredible lineup of Bitcoin speakers, artists, and leaders. Day 1 is Industry Day for enterprising Bitcoiners who are looking to build a business or career within the ecosystem. Days 2 and 3 are General Conference Days featuring speakers like El Salvador President Nayib Bukele, who has promised a big surprise at the event, as well as CEOs like Michael Saylor, Elizabeth Stark, Jack Mallers, Adam Back, and hundreds more. The conference caps off on the 4th day with the world's first and largest Bitcoin music festival, Sound Money Fest, headlined by rapper and fellow Bitcoiner Logic. You're also going to hear from Steve Aoki, CL, Run the Jewels, deadmau5, and many more. Last year's conference sold out, and this year's is on pace to be 3 times larger. So make sure you grab your tickets before it's too late. You can head to b.tc/conference and use the code COINSTORIES for 10% off your pass. Make sure to get those. They will sell out. This portion of today's episode is sponsored by SoFi. With SoFi's all-in-one platform, you can save, spend, earn, borrow, and invest. You can buy stocks and ETFs, open an automated portfolio, or my favorite part, start accumulating Bitcoin, all with no account minimums and 0 commissions on trades. Whether you're new to the world of Bitcoin or you've been dollar cost averaging or trading like a pro for years, SoFi has something for everyone. If you head to SoFi.com/Natalie and sign up for a SoFi Active Invest account, you can win up to $1,000. Thank you so much to SoFi for sponsoring this portion of the episode. All right, there's a lot happening in the market, so I wanted to bring back one of my favorite and most popular guests, David Hunter. Now, David is not a Bitcoiner, at least not yet, but he's a macroeconomic strategist with 48 years of experience on Wall Street. Very popular on Twitter. His handle is @DaveH_Contrarian. And he's a contrarian because he predicts a massive historic deflationary bust that represents the greatest financial crisis in history. And he says it's pretty much right around the corner. Now, the United States keeps doing a good job kicking the can down the road with stimulus, quantitative easing, money printing, but the music can't play forever, right? So David says that he sees indicators that we're headed for the end of this decades-long secular bull market, which he believes is going to culminate with a melt-up rally that's going to spark euphoria and everyone pouring into the market, followed by drawdowns of 80 to 90% in this historic bust, followed by a recovery that's going to shift everybody's allocations, and that could put our whole financial system in jeopardy. And the decisions you make between the melt-up to the bust to the recovery will essentially determine your financial future. So I'm dividing this interview into 3 sections because I really want to hone in on David's thesis. The first is that melt-up rally, which David says is now underway after that correction in equities we saw a couple weeks ago, followed by the bust, what signs to look out for and what it actually means and what it could look like when all of this credit starts to unwind. And then finally, the recovery and what to do in the future as you plan out the next 5-10 years of your life and how to protect yourself and your family. So really important interview. Really thank David for his time. And without further ado, here he is. Let's go ahead and talk about the bust because I'm sure that you were reached out to on Twitter when we were having that correction just a couple of weeks ago. And people were probably asking you, is it the bust? The bust is here, right?
Yeah, not only asking me, calling me an idiot for missing, for thinking it can rally again. So yeah, for sure. I mean, it was a pretty fast unwind, and I think it took a lot of people by surprise who had 2 weeks before been very bullish.
Well, I don't know if you feel this way, but to me, that was almost a sign of what's to come in the sense that investors seem sort of conditioned to what will happen to growth stocks if the Fed were to take action. So, we see these plunges to pre-COVID highs and everyone seems ready to just sell now, ask questions later. And basically, if the Fed moves, I feel like there's going to be this immediate exit instead of an orderly one, which would signify a real crash like you're predicting. So do you think that essentially this bust will be almost a muscle memory in a much larger way of what we saw a couple of weeks ago?
Not really. I really think this is, par for the course. We've seen it. We had flash crashes, going back many years. 2008-9 was very volatile and things happened fast. I think it's the period we're in. Things have really sped up, and certainly with derivatives, with a lot of people playing, turning into traders that weren't before. You just have a lot more with algorithmic trading. You just have a lot more things that happen very fast. And I do think that is the change from when I entered this business. It's a long time ago, but we didn't have computers. We didn't have, it wasn't all trading oriented. Today, people that call themselves investors are really traders. I mean, they're, they think a long period of time is weeks. When I talk long periods of time, sometimes I'm talking, years and decades. So,
yep. Yeah, it seems like the mentality has changed, the technology has changed, the incentive system has changed. If you could pinpoint one reason for why we haven't had the bust yet, what would it be?
I think it's psychology. It's really the fact that, sentiment. It's really the fact that every time we start getting negative, people jump on that negative bandwagon so fast. And probably more than that, it's not so much the shorter term corrections, but throughout this rally from March of 2020, the thing that's elongated it is the skepticism that was with it all the way up. There's still people that were bearish in March of 2020 that have fought this thing all the way and pretty much are saying the same thing they said back then. So, and they'll ultimately be vindicated that they're right about the risks. It's just that the bull market wasn't ready to end yet. So I think probably it's a healthy skepticism that's still out there, or what we call a wall of worry. That's really the fuel for the upside.
Well, you predict that in the bust, we go as far down as 80% in the indices like the S&P. So if the top 500 companies fall that much, what happens to small caps and the riskier segments?
Yeah, I really don't know that we're going to see a lot of difference between them. I mean, there will be stocks that fall 90%, the stocks that fall 50%. But I think it's going to be a very broad-based, very steep decline, because some of the riskiest stocks are our largest stocks. I mean, you've got in the FANGs and in a lot of those stocks, ownership that's built over decades. We've had a long cycle where they led the cycle. And, I know you can make a case for why there's still, decent values. But once things go the other way, I think those stocks can fall. They'll be just day after day after day of people saying, "I got to get out. I don't care what I don't care what the fundamentals are. I need cash. I got to meet margin calls. I got to whatever." So I'm not sure it's going to be so much more downside to small caps versus large caps. I think it's going to be pretty broad-based, deep sell-off.
What do you think happens to riskier emerging market funds?
Same thing. I think it's a global bust. It's a global bear market. They'll all be hit. When you're down 80% in the popular indexes, it pretty much argues there's not going to be a lot of things down 40%. If the big indexes can fall that far, pretty much I think you're going to see a lot of uniformity of decline. It's just people getting out of everything. It's kind of the reverse of what we had, where we've had this all everything rally. We're going to have an all everything sell off.
And you forecasted the 10-year to 0%, the dollar to 120, the euro to 80. Do you expect that could happen by this time next year?
Yes. Well, I don't know if we'll be at those levels. We could be, but we could just easily, it might take until the middle of the year to reach because those are pretty much my, for the dollar, my top levels, although it could exceed 120. And, for the stock market, obviously the bottom. So it might stretch out beyond early February. It could easily be, second quarter of next year before we hit bottom in the markets and top out in the dollar, hit the top in the bond market, et cetera.
Okay, so this isn't the economy, hitting a small speed bump the way we have in previous corrections. This isn't just financial assets selling off. Can you define and kind of crystallize the notion of a bust? Like, is this an economy hard stop? And what does that mean for things like employment? Like, what is a bust to you?
Yeah, this again, we talked about a melt up being very rare. A bust is something, and again, people have different definitions. I've kind of said this is my call, this is my word because I started using it many years ago, and I used it to contrast a bust from a depression and a bust from a recession, and it's kind of caught in between the two.
Okay.
It's something that has some of the characteristics of a depression, but happens in the time frame of a recession. So, using the Great Depression as an example, it pretty much was a decade-long period of decline. Our recessions typically last a year or a year and a half. So that's the time frame I'm looking at. But I think it's being accompanied by a global financial crisis the size of that we haven't seen. So I think that global financial crisis turns a recession into a bust. And I also think it's we're entering this with leverage like we've never had before. So it turns a recession into something far greater. How it can be described in terms of unemployment and stuff, because it will happen probably very fast. Meaning contained within most of the damage contained within a year. You may not have the time to take unemployment to levels it might get to otherwise if we're stretched out. So I'm not sure, but we did see in March of 2020 unemployment get to, and part of that was because they shut down the economy, a good part of it, but we did get unemployment to 35%. So that was a number nobody would ever believe. And if anybody said that beforehand, I don't know that we're going to go back to that because I don't think we're talking about a shutdown of the economy, deliberate shutdown. But certainly you could see unemployment in, pretty high double digits as a result of this. And it's going to, because it's accompanied by economic stock market declines of the magnitude we're talking, wealth is going to be hit so hard. Homes are going to be hit. So I don't know that I have a real picture of how much damage gets done before the government, and I mean government around the world and central banks around the world, before they get a handle on this and actually get it turned around. So because of the magnitude of the stimulus that's going to come in response, within 6 or 9 months of the damage, you're going to be back in recovery. So, and again, they'll declare moratoriums on a lot of things. So defaults and things will be different than what they might have been if the government didn't declare moratoriums.
Well, so do you think that we'll see U.S. bank failures, financial exchange failures?
I'm not sure about exchange failures. I think we'll certainly see global bank failures. I've always pointed to Europe as most vulnerable. I think Canada, Australia's banks are very extended. Asia. So the U.S. is you could see one of the big banks fail, but more likely it's the big banks in Europe, for example. The reason I hesitate saying that we're okay here, we're much better capitalized than we were going into 2008-9. Our banks, we learned our lesson in 2008-9, or certainly, we were the lead lead problem then, and we're not now. But obviously it's a global financial system, and the banks have a lot of counterparty risk. So it's hard to say how that's going to impact, once it really gets going. So, but I do think we're going to see some major, worldwide major bank failures.
Well, at one time you also predicted the euro could fail in the bust. So do you still have that concern? And if euro fails, I'm assuming that other currencies would as well, right? In emerging markets?
Yeah, I don't know about other currencies, but I do think the euro's got, it was obviously created not that long ago, and it's got some restrictions on countries that really can't afford the restrictions when things really turn south. That's the only reason I think it could fail or break up, because Italy and Spain in particular, if you hold the euro together, they don't have the ability to kind of depreciate their currency, devalue their currency to offset the damage that's being done, because they have to be part of the euro. So that's the only reason I think it could break apart. If we're going to have the biggest downturn in 80 years, you got to wonder, how does a currency like that has some of those problems survive? But I'm not predicting it. I'm just saying it is a risk.
Well, in the bust, let's say we do have major bank failures. Obviously, FDIC insurance is $250,000. So what happens to savings over that level? Do you foresee bail-ins, and what about retirement accounts like, TD Ameritrade, for example? What actually happens?
Yeah, let's put it this way. The risks are certainly much higher for the dollars you have in the system that are not insured, that are not at that, below those thresholds. I believe the reason I feel comfortable about the FDIC insurance, so if you have money in a bank up to 250, is because I think the FDIC will be funded to whatever level it needs to be funded to meet that insurance requirement, to meet that their obligation. So because we have the printing press, I can make that statement. But that, yeah, I don't know about SIPC. I don't know, the ones that are outside the government's control, where there's maybe an implicit backing or some sort of backing, it's more of a question mark. And then the ones that are totally private insurance are even a bigger question mark. So people just have to know the risk. I can't foresee or predict, how far it's going to go, but because we're going to have, something bigger in 2008-9, in my opinion, you got to expect there's going to be some of those things that don't stand up. And then the other side of it is, because I do expect not just the US, but the governments around the world to step in ways they've not stepped in history, where they're going to create, just like we saw in 2020, they're going to create some things that we haven't seen before. And in 2008-9, we saw things that we hadn't seen before. There will be, like I said, they'll declare moratoriums on, just like we've seen, renters were, or landlords were told they couldn't foreclose, they couldn't evict tenants that weren't paying their rent. Banks couldn't foreclose on people with mortgages in arrears. So we'll see those kind of things again. We can see all kinds of things, because the government's going to be, as I've said, I fully expect the Fed's balance sheet to grow from the current 9 trillion to at least 20 trillion. And I'm really beginning, as you hear me talk about the magnitude of this, that it could be 30 trillion. I'm just throwing out numbers because I can't wrap my head around or know that. But if you have, if you create $20 trillion, I mean, I don't think these numbers mean anything to anybody, because they just can't.
Right.
$1 trillion is something really large. And if you're creating 20 of those as new money into a system, you can do all kinds of things. You can say, we're gonna give everybody $25,000. You can do all kinds of things. And I'm not endorsing it.
Yeah.
It will end up very badly.
Right.
But it will, when they're in the heat of the battle, when they're deer in headlights and seeing their system collapse all around them,
Right.
they're going to do whatever they can to save it. And that's it sounds simplistic, or without any analysis behind it. But that's reality, is that they will not let the system fail if they have something they can put out there to save it. And the something is money. It's the central banks.
Well, you mentioned, 2008, 2009, that's the last time that people really felt that crash, especially in real estate. A lot of people lost houses. My family lost everything in that crash. So I'm just kind of curious, with this real estate bubble that we've now reinflated, we saw the real estate index climb, I think, higher than ever just last year, 20%. So what happens to real estate? Does it crash harder than the last time?
I don't know if it crashes harder, but certainly I think it's going to be hit hard. I mean, people chasing prices in real estate are not that dissimilar from people chasing prices in stocks. It becomes, if I don't buy today, I've learned that the price is higher tomorrow, right? I mean, people are bidding up 10, 20, 30, 40, $50,000 over an asking price because they want that house, because they're afraid, or they've lost out on other houses. So we're in an environment where it's very clear it's a topping environment. I think the prices we're seeing this year, and we could still have a strong spring, to go along with the strong stock market. So prices may not have topped, but the prices we're seeing this year, I think, will be a high watermark for years to come, just like in the stock market. So, and I do think, some places, obviously markets are local. Some places will probably see 20, 25% hits, and others might see 30% hits. But I don't know whether it's worse than 2008-9. Certainly not. This country, subprime was such a big part of the last time. Our real estate may not get hit as hard. And we're going into it with very low inventories. That can change as people are forced to sell. But there's not the excesses today that we had in 2008. However, Canada has excesses more like we had in 2008. Australia has, I've got a lot of subscribers to my letter from Australia, and they just say it's insane over here, and has been for 20 years. So you're looking at real estate in lots of other areas of the world that can come down really hard. And if real estate comes down really hard, it really hits the banks very hard. So
yeah. Well, again, I mean, you call this the greatest financial crisis in history. And I think that conjures up some really visceral images. And I want to get totally real here, because I think, especially here in the US, where we're insulated and the Fed has always swooped in, it's hard to imagine just sort of mass, civil unrest or starvation. But I mean, how negative would the effects of this kind of bust be? I mean, we're talking probably in 24 months, at least outside of the US, people dying, right?
Well, let's look. I don't know about that, but let's look at what we've had in the last 2 years. The pandemic has really changed a lot of things in this country. We're seeing a lot more cop killings. We're seeing a lot more things in the urban centers. At the same time, we're seeing legislation out there saying we're not going to lock people up. We're going to let them free. It's just an entirely, and I'm just speaking of this country, but it's an entirely different mindset than we had just 2 years ago. And so when you put that in to a mix where you're looking at the worst economic situation you've had in post World War II era, a lot can happen that is hard to predict, but it kind of says you're going to be in a period of chaos. So I hope not. I mean, I hope things stay civil. And I do think that the speed with which the authorities will respond to the economy with massive money and massive fiscal spending means you won't be down long enough, maybe, that we just totally go into absolute anarchy and chaos. There's a bigger cycle coming, I think, after the next recovery. And in that one, I can see all of that. But I think this one probably is going to be mostly financially driven, wealth driven, and food shortages and things like that are happening anyway. So we could see certainly some of that, but I'm not so worried that's why I call it a bust rather than long drawn out depression. I'm not so worried because I think this one's pretty fast. It's devastating while we're in it, but we come out of it pretty quickly and relatively. I mean, it won't feel like you're coming out quickly for the year you're in it or the 15 months you're in it, but on a relative historical basis, that's pretty quick.
All right. Thank you so much for watching this portion of the interview. That was David Hunter describing a little bit more about his forecast of this historic bust that represents the greatest financial crisis in our history. And of course, this begs the question, what next? What does the recovery look like? How can we protect ourselves and our families? So that's what I focused on in the last part of the interview. Please make sure to subscribe to this page and like this video so other people find it, and look out for part 3 of my interview with David Hunter.